The following podcast is recorded and produced by Emerge, a media creators co-op.
Welcome to the Defion Productions podcast. I'm your host, the hardest working nobody in Bitcoin, Don. A lot to talk about today. Bitcoin has jumped 20%, 20% plus in the past 7 calendar days. I do have CoinMarketCap up on my screen right now that we can take a look at. The price was about 64,500 about a week ago. And then we had some news come out that we're going to talk about shortly about kind of why this has happened. And we had a nice little price pump. We went from 64 to, I believe, we got right around 80. We hit about 80,000. What day is that? That's the 24th of August. So that would be, what's today, 25th? Yesterday, we got around 80K. Got rejected. Came back down a bit. I did see earlier today we were hanging out in the 77s, bounced back. Right now, sitting at 78,594. Why are we sitting at 78 after being at the low 60s last week? Well, the administration of Mr. Trump and Mr. Bessent decided that they want to start printing more money. Not necessarily in the old-fashioned way, but Scott Bessent, the Treasury Secretary, announced a buyback and the buyback of the bond market because the bond market is shit and bonds are shit and people are realizing that they're shit, so they're trying to prop them up. So Bessent made a little play, and assets like Bitcoin, even gold and silver had a little bit of a run, started to move because this is what they do. This is not sustainable, as we've been saying on this podcast year after year. Safety Amos posted this earlier. Bessent's $4 billion buyback plan last week was like walking into a kitchen and asking for a cup of water to put out a fire in the living room. Asking for only a cup doesn't magically make people calm that it is a small fire. It makes them worry about the fire and worry even more that your measly cup won't be enough to put it out. The difference is that in the bond market, their worry fuels the fire. So the Kobayashi letter here, the U.S. Treasury is considering using its $950 billion general account to help fund its increased purchases of long-term government bonds. Once again, the era of bond market intervention officially began on August 19th. This is a top priority for the Trump administration. So I had this good article. David Weisenberger, who is the host of the Finance Daily Show on X, which I listen to religiously every single morning, starts about 8 p.m. Eastern Standard Time and runs till about 9:30. I try to listen to it on my way into work and in the beginning parts of my work every single day. And he posted something that I thought was worth sharing yesterday. Bitcoin is rallying for a reason, a thread. Debt just crossed 40 trillion, while policymakers line up to monetize it. That combination signals the start of a major hard asset rally. Last week, Bitcoin plus 23%, gold plus 6%. Stocks saw only small moves. Bonds were basically flat. As Paul Tudor Jones put it years ago, Bitcoin is still the fastest horse. Scott Bessent made the policy intent clear. Treasury is expanding long end buybacks and calling it a Treasury twist. Cut long-term supply, push more issuance to the front end, and try to force longer yields lower. That is yield curve control in everything but the formal label. Treasury cannot hold the long end alone. The market already pushed back. Sustained suppression eventually needs the Fed's balance sheet. When markets start pricing that, Kevin Warsh will accommodate, or at least not obstruct. That effort, the odds of actual debt monetization, rise sharply. The mechanism is straightforward. Structural deficits keep adding claims that must be held. Leveraged private buyers absorb them until stress appears. When the fiscal side signals it will not tolerate higher or longer rates, and the monetary side is expected to lean against disorder, the backstop becomes more systemic. Liquidity expands, hard assets reprice first. 40 trillion was the constraint made visible. Bessent's move is the fiscal response. Worse accommodation or the credible expectation of it is the monetization risk premium. Bitcoin is not rallying on vibes. It is pricing the path of least resistance, more liquidity, not less. The implication is unmistakable. While short covering increased the magnitude of the rally, last week's move certainly seems like the current group of Bitcoin holders see it as the future of hard assets. Considering Bitcoin is just a fraction, 5% of gold's monetary value, its potential is far beyond that of other assets. So, what does all that mean? Kind of what we're kind of here to talk about, right? Um, it's no coincidence that we officially passed 40 trillion late last week in the federal deficit, and then right after that, the Treasury Secretary decides to intervene in the bond market to prop up bonds, and that smart money starts flowing to hard assets like gold, which was up 6%, which is pretty good, and then Bitcoin, which moved 20%, which is huge, especially seeing that we're at a time in what people would consider to be, if they believe in cycles, the cycle theory, a time where Bitcoin should be flat or even moving down, where most people still subscribe to the idea that Bitcoin is going to bottom in October, which September is a week from today, right? September 1st is a week from today. So a month from next week will be October, where most people seem to think that, your chart squigglers seem to think that Bitcoin's going to bottom. So if Bitcoin's going to be bottoming in a month and then it makes this big 20% move because the macroeconomics are kind of shifting, like what does that say for the charts and what does that say for, the traders and all that kind of nonsense? What it says to me is what it's always said. Like, this is a long game. I can't predict what's going to happen in the short term. I couldn't predict that, last week that move for 20% was going to happen for Bitcoin. That was going to go from 60, 63, 64,000 to 80. Like, I couldn't predict that. Nobody can predict that in the short term. What I can fathom is that in the long term, with the long term thesis, is that Bitcoin just is going to continue to go up because liquidity is going to continue to flood the market because we're going to continue to print because that $40 trillion number is not going down, it's going up. So it's going to be 40 trillion, 45 trillion, 50 trillion, 60 trillion, 100 trillion. They're going to continue to print until this whole thing collapses. And when the whole thing collapses, Bitcoin is going to be what's left standing anyways. So number go up eventually. So that's kind of what we're seeing. And when you see a little snapshot of that in this play in the last 7 days, that smart money flew really, really quickly to Bitcoin on that move. And in the grand scheme of things, it's not really a huge decision by Besson. It's not like earth shattering. And we still had a 20% shock to the market. So, what happens when something major happens? What happens when we get that AI bubble collapse, which I think is inevitable? I was actually texting with my brother this morning, and we were kind of talking about like what we think that catalyst for the next market crash is going to be. And I think it's going to be the AI bubble. And I kind of said to him, I think we still have maybe a potentially 3 to 5 year runway before that bubble actually pops, because there's still a lot of money flowing into these AI stocks. There's still a lot of money flowing into the AI sector. And I don't think that's going to stop anytime relatively soon. But much like the dot-com bubble, there's going to be winners and there's going to be a lot of losers. I think there's going to be like very few winners, kind of like there were in the dot-com bubble, and those winners are going to like really, really be winners. They're going to be the Amazons and the Yahoos and the companies that came out of that dot-com rubble and really like made it and changed society. And will it be Anthropic? Will it be Nvidia? I don't know. I'm not well versed enough in the AI space to really make that call, but there will be some. There will be ones that do survive, but then there's going to be ones that crash, and the money will stop going in, and people will seek safe havens, and I think Bitcoin will be one of those. Rich, you have any thoughts on these market moves in the treasury market or the?
I'm going to be honest, I don't understand the bond market at all. Like,
Okay.
it's one of those things. I was really interested in your pod this week because I thought you would explain it or find a guy that could explain it, and I think I understand it a little bit more. But this crap with the bond market, it's so to me. I know it's a phony move. It's not a real move. It's like you're printing money, you're buying back money that you just printed. Like, it's just weird. And in the middle of all this stuff that was going on, we're starting the trade war with Canada again, and and Canada owns like a great deal of the US bond market too. Like, so it's just weird. Like, I don't understand it. It doesn't seem like any of these decisions make any sense to me. Just, I don't understand how they're going to help the overall economy. Um, but I did understand, because enough to understand with what was happening, why it helped Bitcoin, and then even like you said, helped gold and silver and some other things. And then it didn't. It just the stock market just didn't react at all, which was right. Like, it didn't feel like the stock market did anything. Like, it just, I feel like the stock market's
Relatively flat.
like,
Yeah,
I feel
relatively
like you said
flat.
it last week, maybe the week before. Like, the stock market's just not really doing. It's not jumping big. It's not
The
dropping. It has that.
the stock market as a whole isn't really doing anything. It's the AI stocks that move, and then some other like little stocks here and there. But the AI stocks are carrying the market. Like as a whole, the S&P 500 is being carried by the Mag 8, the Mag 7, whatever you want to call it. Like the take those stocks out of there, and it's relatively flat or even down. And then compared to, when you match it up against inflation, it's definitely not certain.
So you think the administration's decision to do the bond market thing was a what? Obviously, it was related to like the news and with the debt. What was confusing to me was why they thought that would help.
Let me let me
I mean,
let me let me
that's probably where I'm most confused.
let me explain the basics. I put up a quick AI search about explaining the bond market in simple terms, so we can kind of like get a baseline here. Think of the bond market as a big lending platform where people and organizations can borrow money, and investors can lend it in return for interest payments and the return of their original investment at the end of the loan term. What is a bond? A bond is like a loan you give to a company, government, or municipality. When you buy a bond, you're lending them money. In return, they promise to pay you interest, called a coupon, at regular intervals, either yearly or semi annually. Return your principal, the amount you lent, on a set date called the maturity date. For example, if you buy a $1,000 bond with a 5% coupon, you get $50 in interest each year, plus your $1,000 back when the bond matures. How the bond market works. The bond market has two main parts. Number one, the primary market, where new bonds are sold directly to investors by the issuer, like a company or government. The issuer sets the terms, the interest rate, maturity, face value, and investors decide if they want to buy. Secondary market, where investors who already own a bond can sell it to other investors. Prices here can change based on factors like interest rates, the issuer's creditworthiness, and market demand. Why it matters. For borrowers, bonds help governments and companies raise money without going to banks. For investors, bonds can provide steady income, help preserve capital, and reduce portfolio volatility compared to stocks. Key factors that affect bonds. Interest rates. When rates rise, existing bond prices often fall, and vice versa. Credit quality. Bonds from strong issuers like the U.S. government are generally safer. Maturity date. Short-term bonds pay interest sooner but carry less risk. Long-term bonds offer higher potential returns but more risk. In short, the bond market is where you can lend money to governments or companies and earn interest, with the promise of getting your money back at the end. It's a key part of the economy and a popular way for investors to balance risk and income.
So I own a bond. Okay, I buy 3 bonds from the United States. Like United States bonds. But I want now. When do I get to say I want my money?
Well, you're going to get paid your coupon
Yeah.
based on how long you're taking the bond out for.
Right.
So for short-term bonds, you would get, semi-annually, annually, whatever the case may be, and then your principal would come back if you did a 2-year bond or, 5-year bond. Longer-term bonds, you're gonna have to wait longer to get your principal back. You're gonna get paid more money, but the risk is higher because look at just in the past couple of years how much, like, you could have gotten a bond in 2022, 2021 at a completely different rate, interest rate wise, because rates were next to zero,
right,
compared to where they are now.
And at that point, the bond market wasn't really worth a lot because
Right.
nobody was buying bonds because the interest rates were so
The
bad.
problem for the government now is that the rates that they have to refinance I think I saw 8 or 9 trillion, like 8 or 9 trillions coming due, like relatively. It might be this quarter, at like 5%.
And
Like they have to
that
pay
was
five
and
percent
that was
interest on
kind
it.
of why I thought that it was interesting that he started this like all this crap with Canada again, because Canada owns like a significant amount of bonds, and if some of those are coming due, they're not going to roll it over per se or whatever you can do. You can kind of keep your bond and say no, I'm going to continue my investment, or you can say no, I want my money now, which is a funny thing because like I don't see Canada like a wanting to bother with the bonds right now. I mean, I don't know. Like, I don't know. Again, I'm not claiming to be an expert on that stuff, but there could be like just the pettiness of what's going on between our governments, right? The two governments right now.
I just had it up here. Okay, so let's look at Bessent's move specifically. Why Bessent's bond buyback move happened. In simple terms, Treasury Secretary Bessent stepped in to buy more of the U.S. government's long term bonds so that interest rates wouldn't keep rising to dangerous levels. The problem: for the past week, long term U.S. Treasury yields, especially the 30-year bond, hit their highest since 2007, around 5.3%. This is bad news because higher yields mean higher borrowing costs for mortgages, business loans, and government debt. It can make it harder for people to afford homes, for companies to expand, and the government to pay off its huge debt. Investors were selling long term treasuries, which pushed prices down and rates up. This The causes included a massive $2.1 trillion budget deficit and $40 trillion debt load. Inflation still around 3.4%, which I think is bullshit. It's definitely higher than that. A surge in corporate borrowing for AI data centers, competing with treasuries for investor money, geopolitical risks like the U.S. Iran tensions, which could keep oil prices high and inflation elevated. Why Bessent acted now? Bessent's move came just before the U.S. midterm elections, when political leaders want to avoid bond market chaos becoming a political issue. I think they're beyond that. I mean,
I don't think it matters.
yeah, I think they're way beyond the point of no return there. He's been trying for years to keep the 10-year Treasury yield lower, and this was the latest in a series of interventions to calm the market. What he did: starting September 9th, 2026, the Treasury will double the size of its long end bond buybacks from $2 billion to at least $4 billion per operation. Do it more often, from 2 to 4 times per quarter. Focus on bonds maturing in 10 to 20 years and 20 to 30 years, so the long end. By buying these bonds, the government is trying to push prices up and yields down, making borrowing cheaper in the long term, which is a big issue for them right now because they have debt that's coming to maturity that they have to refinance. Bottom line, Bessent's move is like a temporary cooling off for the bond market. It's meant to stop yields from getting even higher, lower mortgage and loan rates for consumers and businesses, give the Fed and Treasury more breathing room to manage inflation and debt. But experts warn it's a small fix compared to the big problems. The debt is huge, inflation is still high, and corporate borrowing is booming. AI, right?
Yep.
This is all like coming together to form like what I believe is like an event, like a potential chaotic economic event.
Well, the one
So,
post that I saw was that it was saying that like when you're talking about the collapse of things, the AI bubble, the collapse, this is going to accelerate that collapse. Like if that collapse is supposed to come, let's say, naturally, organically in 4 years, people like it might come a year earlier now because this is kind of created it's just fake. It's another fake thing that the government's kind of doing. It's kind of like it's like there's movies about this where you like where the guy finances a movie by getting all these credit cards, and he pays for the movie with all these credit cards with the hope that the movie does well. If the movie does well, great, because then he'll be able to pay all those bills. But if the movie tanks and he makes no money, then he's screwed. And that's kind of what like the way I look at this. It's like you're spending all this money that you really isn't real money to begin with because you're just printing it. And that's and you're thinking, and I just like you said, I just don't feel like how this is going to make a difference with any regular consumer. I think 90% of regular consumers that are worried about affordability and all that, the buzzwords that are going around now, don't care about the bond market. They just don't because they're not buying bonds. So there's the gas is not high going down. I mean, he did a whole thing with ground beef or something to try to lower beef prices. He's throwing stuff at the wall to try to figure out how to stop the bleeding in the economy right
Rich, you're a producer for a finance podcast, and you don't even. This isn't a knock on you,
now. No,
but you don't even like properly understand bond markets. So the average person walking around for sure doesn't understand bond markets. So people don't really even understand what's happening. They just, oh, Bitcoin went up. Oh, Bitcoin went up. What's the reason? And somebody says, oh, the bond market's, oh, and then it's just like in one year out the other. They don't really understand. So they don't even know like how significant and serious like what Besant had to do. Like it's like a Band-Aid for like a scar that needs like stitches. Like that's what we're doing. That's like the best way I can kind of explain it. I've shared Marilyn Hoddle multiple times on this podcast, things that he's written. This is very, very small compared to what he typically writes, but I thought this was good to share. Bitcoin wants to see how Warsh responds. Warsh is our Fed chair, and he'll be speaking soon to see like how he's going to be responding to all this, because like the Fed is watching what Besant did, and they're going to have to react in some sort of way. The real question is which version of the show we get. Number one, a manufactured war between the Treasury and the Fed. That'd be between Besant and Warsh. Warsh falls in line and plays Trump's good little inside man, providing monetary cover for what Besant is already doing. 3, Warsh puts up just enough resistance to force Besant's hand, ultimately demonstrating to the rest of the Fed just how little control they actually have over the long end anymore. The interesting part is that the underlying tension is real. Besant is actively trying to suppress long-duration yields through expanded Treasury buybacks, while Warsh has been arguing that markets should have greater freedom to set financial conditions. That's important. That's an important stage to set for people. Like the Trump administration adamantly wants to control things. Warsh, through I believe it's 2 now, the 2 meetings, the 2 times he spoke, is kind of said he wants there to be a free market, which doesn't exist. We don't have a free market. And Warsh has kind of been saying like he wants to let the market kind of do market things, let financial conditions kind of like set the stage for themselves. That's not the school that Trump subscribes to. Right. And Besant's move this week is showing that they want to control what they can control, right? Either way, I think we ultimately arrive at the same destination. The only question is how much theater is required to get there. It's showmanship for the mob. And Bitcoin isn't waiting to hear what Warsh says. It's watching to see who actually has the power when words collide with the bond market. This is pretty big, but like people don't. And here's the thing too. And let me be like completely like frank and like with this podcast. I could spend the next like 40 minutes trying to talk about this and nobody's going to get it. Like people just don't understand. And I'll be totally honest. Like I'm a Bitcoiner. I'm a finance like hobbyist. I can say like I'm not a finance guy. Like I don't do finance every single day. So there's even parts of this where I don't completely fully comprehend it. And I study this stuff and I'm like studying the fact where like I'm intrigued and I read things and I'm well versed in it. But the average person that would be watching this podcast probably has no idea like what's happening or, you know, what's going on. And they hear anybody that follows me knows that I talk about the debt-based Ponzi scheme and, you know, money printing and all that kind of stuff. And I think people kind of are starting to understand that and starting to get that only because of the years and years of inflation that we're seeing and what we experienced through COVID. People kind of get it, like we just created money out of thin air. They're starting to understand that. But this bond market stuff is like next level. And unfortunately, that's what's going to kind of be what breaks everything down. And I think that people aren't really going to truly understand it until the Big Short movie is made on whatever this event that happens when that comes out. You know what I mean? Because I don't think people truly understood the GFC until they watched something like The Big Short or started consuming documentaries and were like, oh, that's what happened. Oh, they were packaging mortgages that were shitty into ones that were good, and people didn't understand what they were buying, and people was just like YOLOing into, you know what I mean? Like people didn't really get it until the documentaries came out and people broke it down, right. And people way smarter than me were explaining it. So I think like for me to try to spend time to explain what's happening in real time in one ear, out the other. People aren't really going to get
Well,
it.
and Bessett's the worst person to try to explain it because he doesn't seem to.
Tell me
He does not come across.
that Will Ferrell can't play him on a
Oh
Saturday
my
night.
God, I never thought of
Tell
that.
me,
but
tell me that Will Ferrell
yeah.
couldn't nail.
Just put his
Besson.
glasses on in a weird
Put
way.
the
like,
weird,
put his head up.
Tell
and-
me he's not
yeah,
Besson all day.
Yeah, they should bring him
Saturday
in.
Night
for-
Live is sleeping on that.
Yeah, they really should have him in as a
Sleeping
guest
on
or
that.
something because he just says he goes off on these tangents and he says things whenever he talks about anything. He talked about the job market at one point. He talked about unemployment. Like anytime the guy talks, it's like he just makes stuff up. Like and it's and he counters his own arguments quite often in his description of what he's doing on other topics when he's talked about things. So I just don't, I don't think people I don't think people watch him and
Tell me this. Tell me
You know,
this is
I mean,
not Will
switch to
Ferrell.
it, yeah.
Tell me this is not Will Ferrell.
When it comes to the size of our debt, with public debt increasing to now $40 trillion.
Yeah, I mean, look, Sarah, there's nothing magic about the 40 trillion number, and we can grow our way out of that. So, but what we do want to signal is, I think that there's been a lot of misinformation in terms of what's going on with the deficit, what's going on with the deficit to GDP. We actually had a fiscal consolidation for the.
I mean, come on. How is Will Ferrell not come out
Will
and
Ferrell could just make shit up.
I mean,
and
it's
he'd
just.
be fine.
I mean, it's right there. Like
Yeah.
every time I see Besson talk, I'm like, how is Will Ferrell not
Yeah.
playing him?
He's even a tall, goofy looking guy. He's
It's
tall.
perfect,
Yeah,
and he's got that voice where he like messes around, where he could just literally be
Yeah.
Besson. It's
I mean, and it's funny because the business shows are kind of funny because there are the guys that are falling in line with whatever party they want to support. Most of them are pretty straightforward. Now, most of them they have, you can tell they lean one political way or another, but in general, business shows, kind of like sports shows, they tend to just be they're reading the data. They're talking about data and stuff and not how you feel about it and if only like we got rid of illegal immigrants, all that's, they don't do that. They say this is what's happening, these are the charts, this is how I'm interpreting it. They may be wrong and maybe it has a lean from one way or the other, but like at least those shows will challenge these guys when they come on, and not just government officials. Some of the guys that come on that are investment guys or corporate CEOs, they challenge those guys too. So and gals. So I mean, yeah, like at least she was asking him some questions and he didn't know how to answer.
Yeah. We've covered some MicroStrategy stuff in the past couple of podcasts. How fast things can turn around, especially when you own a shit ton of Bitcoin. So Michael Saylor's strategy swung from a $9.5 billion plus loss on their balance sheet to $4.7 billion in profit in 1 week on their 840,447 Bitcoin. That 20% move, almost 10 billion in losses, are now almost 5 billion in gains. That's wild.
Well,
that's how quick the narrative shifts. And why and again, I'm not as big of a Saylor like lover as like a lot of people are. And I was earlier, and I still think he says a lot of good things about Saylor, but at the end of the day, he's a fiat billionaire and he still wants you to own paper Bitcoin. And I don't get down with that, but he's playing the long game. Like this dude don't blink. Like Bitcoin could drop 50%.
He sells his Bitcoin, he buys more back.
Yeah, way more back
because he needs cash.
Mm-hmm. He's operating a business.
It's like you have like it's kind of like I have 3 bags of empty cans in my garage, and I need a little bit of cash because I'm going to go buy a case of beer. So I'm just going to take the cans and I'm going to go to consumer beverage and use that as part of the cost to buy the beer, full well knowing that what do I have in my garage after I drink the beer? I have more cans. And I think he does that with the Bitcoin. He pulls out a certain amount of fiat, does something with it, and then ends up buying back his Bitcoin. Like they sell it. he never sells anything significant. It's always like nothing. It's like what? It's always less than 1/10 of 1% of what they have. It's nothing. But he always buys, but everybody, oh, there you go. There's the end of Bitcoin. Look, it's Michael Saylor selling. And I'm like, can I see it on Threads and some other things that I'm on? It's funny.
Also, we got BlackRock. BlackRock clients purchased 208.93 million in BTC Bitcoin via IBIT on August 24th. This extends a robust accumulation phase with 1.33 billion added last week. The largest weekly total since the October 2025 all-time high. Institutional demand remains a key driver of market structure. Charts detail the 31-day flow and history, flow history and cumulative trends. You can kind of see going back to June, July, and then here we are with flows. Obviously, this is institutional investing. They follow the trends. Like, I mean, it's just kind of what it is. Nothing really crazy there. I want to share Jump Out Girls. They're a Bitcoin podcast, women podcast. Shout out to the Jump Out Girls. Follow them on X. They got a cool podcast. They retweeted leading report, which this is crazy. It should make you vomit if you're my age and my demographic. 50K income in 1990 requires roughly 130K in 2026 to have the same purchasing power. That's wild.
Yeah.
I mean, and the crazy part is, like, people from the 90s, like my generation, they still don't realize that, like, you have to make so much more money. Like, you need to aim a little higher, because you're not gonna make it in the fiat world, because things just keep getting more and more expensive. And I again, shout out to my brother. We text almost every day, and I was telling him, man, like, the average working family in 1990 has a better quality of life than the average working family in 2026, and I don't even think it's debatable.
And it's funny because the comment that I should go back to the comment. The person down there, Freedom Farm, was sure is strange knowing you grew up in a different world.
Yep.
And obviously, I'm old enough. In 1990, I had gotten 1991, I got my first real job. So, I mean, I was making real, like, job that I had gone to school for. And, and then I bought my first house, my second year of teaching. So I don't think, if you just take that analogy, I don't think there's a lot of second year teachers just picking one profession and looking at it 35 years later. I don't think that you would say there's a lot of second year teachers that can afford to buy a home.
No shot.
Right?
I don't think it's possible.
And
Unless they have
outside, that's
an outside source.
It's not even empirical data. What do they call that? That's just like an example. There's a word for that.
An outside source would have to be
right.
Available to them, whether it's like a family member or a spouse.
Yeah, you inherited,
or their spouse makes is an electrical engineer or some shit.
Yeah, or you're like, and again, I was single. I bought my first house when I was single.
Yeah.
I mean,
single second year teachers, no shot.
If there were two people
single second year teacher, no shot.
Now, there was this funny article that popped up on X the other day that was saying, well, the problem is, and this is and there is some truth to it, is that, but look at the size of houses that young people want now. And I'm like, okay, so you are throwing in the fact that people people seem to want these bigger houses now. And I get that. I think that as consumers, what I think the article what I would take out of the article, and this is, what do you think about this, is that I think younger generations also, they don't seem to understand. They seem to be buying the wrong, like spending too much on the wrong things. And I don't mean like the avocado toast bullshit. I'm talking about, like, cars are more expensive, but then some of them seem to want to spend money on like a bigger car or getting a car more often. Or again, maybe they're buying like, a 1,200 square foot house isn't big enough. They want an 1,800 square foot house. I think that there is some truth to that the younger generations seem to want, not every, because a lot of them also want less, But I think there is like that part of the consumers that seems, and I don't even think just younger people. I think middle-aged people are doing this too, and that does affect your buying power. But even if you weren't, but forget about that in the sense that just go back to the smaller numbers. They just can't do it anyway. Even if it was just a smaller house, it's the same problem.
I don't think this data is correct. I'm looking up. It first it told me in $2026, so I had to refine my search, and it's still saying there's no way. We both born and raised in Niagara Falls in
That's
1990. In 1990, the average home was not anywhere near 100 grand. This is
as someone that bought a house in that time period. That is not accurate. There's something wrong with that. That date is really skewed.
And I have a friend who says that that AI is biased, and I rely on it too much. I think this is shout out to my buddy Tony Winters. This is an instance where I think that AI is completely.
I can tell you
because
that
it's telling me it's telling me here that right now the average home price is 175. There's no way that it hasn't doubled. I think it's higher than 175.
No, for sure. Yeah. Let's look at it again.
As of July 31st, 2026, the average home value in Niagara Falls is $175,991.
Okay, so is that basing on every house, every value of every house, or is it basing of houses in the market?
Not sure.
Because if it's doing it based on, you have a lot of abandoned homes and houses that are worth like $14,000, $15,000, $20,000 because they're not occupied, they're boarded up, they're condemned. I think I need more like, and then that 92 is wrong. That I can tell you from a guy who bought his first house for 92. That was about what I bought. I think it was 93. And I probably spent more than I needed to. But I know most of my friends that were buying houses, their starter homes, they were spending 65, 70. Most of my friends were buying houses in the 65 to 75 range. I decided to buy a little bit bigger house because I thought that it was a bad financial decision. I'll tell you right now, it was a bad financial decision. But I was young and stupid, so I had a little cash to play with. That does not seem right.
Okay. I still think these numbers are skewed, but it'll still drive the point home. So in 1990, the average wage in the United States was approximately $28,960, where the median household that's crazy. How does that make?
I would agree.
It doesn't make sense though. Median household income. So household income would be 30. So that means two people working.
Right.
So that I don't understand how they approximate that, but I guess. Okay, so now adjusting for inflation. So in 1990, typical U.S. worker earned around $29,000. So I did the same thing for today. So today that number has gone to 63.7. So it's gone up 100% basically, right?
Yeah.
So then I did this. What is the inflation rate from 1990 to 2026? From 1990 to 2026, the average inflation rate in the United States was about 2.64%. This means that over the 36-year period, prices rose by roughly 155.48%. So $1 in 1990 would have the same buying power as $2.55 in 2026. So this is where this, even if it's kind of skewed, still drives the point home.
Right.
So we're going to use the average because we don't know like people what profession you can choose. Like you can have skews on all that.
Right.
We're just using like an average person X. This is average person X. So average person X made 30 grand in 1990. Okay. Average person X in 2026 makes about 60 grand. So 60 grand, right? So 100% more. So it's 100%. They're making 100% more. The cost of them subsiding has gone up 155%. So the cost of what the amount that they've earned has gone up 100%. They're still down 50% in how much they have to spend on goods and services. That is what's happening in this country. That is why Bitcoin was created. That, in a nutshell, is not sustainable. That is what people are feeling. The average person is making 100% more in 36 years, yet the cost of subsiding has gone up 155%.
And that's not even incorporating things that are beyond that when you look at health insurance, because 36 years ago, 35 years ago, health insurance was that back then a lot of unions would make health insurance free because it didn't cost anything. Now everybody's paying into their health insurance. There's a lot of things that are not covered depending how good your health insurance is. So, I mean, if you just look at health insurance, that is just an added thing that is cutting into the pie of people's expenses. That's you're adding, not only are you, again, your buying power is lower, you have now these other things that you need to function. You have an extra utility that we didn't really have. I mean, it's a utility, internet, cell phone, that's another utility that we all use and have to have now that we didn't have in 1990. Your cell phone bill was probably what, $30 a month or something back
All right,
then?
so I'm real time in this while you're talking. You brought up health insurance. So there's no completely reliable data, but the estimated multiplier says if we take the 1990 average family premium of $7K per year and compare it to the 2026 average of $25K per year, the total premium cost is roughly quadrupled. So 400%.
Yeah.
So wages have gone up 100. The average of what they consider to be inflation has gone up 155, but health insurance has gone up.
Is there anything you can think of that we could do this all night? Is there
Yeah,
anything you can
I'm
think
doing-
of that has kept pace that salaries and wages have kept pace with? Maybe gas? Maybe gas? Yeah,
No,
that's a political thing.
No. I mean, gas is the best example, but gas in 1990, gas was under $1.
Was it under $1?
Of course it was.
I don't remember.
I would go in 96. I was going to
don't
the res and
remember.
getting it for like 80 something cents. So it was like a buck.
But I mean, we have a fake inflated, not fake, it's not fake, but we have gas is high right now, higher than it should be. But gas is probably not, because again, I think there's a political aspect to gas.
So car insurance is also 4x. I put car insurance in. Car
Without
insurance
a
is
doubt.
also 4x.
Home insurance.
So
Insurance in
let's
general.
think of something like what else would not be considered regular inflation. So we got homes, we got cars, we got health insurance. What's something else that we pay for?
I mean, like I said, even technology. Like
Technology's actually gone down. Technology's the one area. TVs are less. Like
TVs are less but I will say, but when TVs are less though, because of antitrust settlements, because that was one where we fought, the people got lawsuits together and they fought Sony and Paramount, and they had created those not Paramount, Panasonic, and they got sued because they were charging ridiculous amounts of money for televisions, and that allowed companies like Vizio and what's the other one, LG to exist, and you were allowed to have TVs but that was because that was antitrust. Like I remember that TVs came down, but there's some stuff that seems like entertainment certainly has all gone up, concerts have gone up, food's certainly gone up, car prices have gone up, and I don't know. Vacations. I can't think of anything.
I literally just put vacation in there. I look at the screen. I literally just put vacation in there.
Yeah.
How much more expensive is an average? I think this is important because vacation is like where we take our downtime, our 2 weeks of PTO that you get, or whatever the hell the average is. So according to historical data, a week-long vacation for a family of the U.S. and went back to 95 was $1,550 in 1995. Adjusted to 1990 levels, similar vacations would be approximately the same range, slightly lower, around $1,500. Vacation costs in 2026. Recent sources indicate that a family of four on a domestic vacation in 2026 spends on average $7,200 for a 7-day trip, an increase of 364%. Again, for context, wages have gone up about 100%. What they're telling us, inflation has gone up, which I keep telling you is bullshit. The inflation numbers we use, complete bullshit, because we've just done 4 different areas that are in the 300 to 400% range. So the average inflation that they're telling us of 2.64%, which again, bullshit, is 155%. So we're lagging that by 50%. Health insurance, we're lagging 400%. Car insurance, we're lagging 400%. Vacations, we're lagging 360%. Three major things that most families engage
Let's
in.
throw it in because we might as well do it. Throw in education.
Oh, Jesus.
Like, might as well do it because that's the other real big one that families deal with.
I feel like this is going to be a lie. I feel like they're gonna fib this, but we'll see what it comes up. I guess not. I guess
Holy
not.
shit.
College to
That's the worst one, right?
Yeah, dude. This is we're doing some work here for the people, for the 19 people that are tuned in right now, and hopefully anybody that watches this on playback.
I never would have guessed it was over 400%.
This is why, again, I want to take this opportunity. Please, if you're watching this, like, subscribe, share, subscribe to my podcast, all that stuff. This is why I do this podcast, because I need people to understand that the path that we're on is not sustainable. Stop worrying so much about who goes in what bathroom. Focus on the shit that really matters. You're only getting 100% more money 36 years ago today, but you're paying 400% plus for car insurance, for health insurance, to go on a vacation, to get a better job and go to an institution of higher learning. College tuition increased by 453.73% from 1990 to 2026, meaning a $20,000 tuition in 1990 costs $110,746.50. Again, I want to reiterate this because I say it many times and I trigger people. College is a full-blown fucking scam. Full stop. College is a scam. To pay 453% more for education today, when you have a computer in your pocket and most of the shit that you were paying less and back then, and you're paying 450% more. They were doing more work back then than they're doing today because everything's at your fingertips now. Right?
Yeah.
I mean, you had to do way more work back then. They had to do more work as professors. Everybody had to do more work. It's less now, and you got to pay 450% more. Mind-boggling. Absolute mind-boggling shit. And if you're watching this, your blood should be boiling. Your blood should absolutely be boiling. And Scott Bessent is jumping out in front of cameras to do Band-Aids on a gash. And this is where we're at. 40 trillion in debt.
And then just back to the concept of education, that's because again, we've been sold, and it's the same. This is the same thing you hit on all the time, is that, people don't want to believe it. Like they got to get their head out of the sand, and they're allowing themselves to be, whether it's your local politician, whether it's your federal politicians, whatever it is, like you're these groups that are buying your politicians and telling them things, and you buy it because you just don't have enough, because your media has all been co-opted. You used to have like 120 different media companies, and now we're down to essentially 8 that own everything. So the messaging is consistent across those 8 companies for the most part.
I should have done this a long time ago, and I did it while you were talking. And this is where it is right here. This is where my ethos lies, and why I say college is a scam. My generation was sold the lie that you had to go to college or you were considered a failure. If you went to BOCES and you got a trade and you went they were considered failures back then. You had to go get an education because everybody said, go to college. That's where the successful people go. Well, in 1990, if you decided to go to college and get an education, your wages went up 100%. We just went through that, right? Let's take a look at if you decided to go to trade school and get a trade instead of going to college, okay? Let's just take a look at average wages for plumbers, 63, electrician, 63, sheet metal, 61, HVAC, 61, laborers, elevator installer, I don't know, but median wages. So median wages in 1990, 24K for electrician, plumber 22, construction labor 15 to 18. Relative increases. taking into consideration that it was about 22,000 that they were averaging back then, which is less than what the average was making.
Right.
They're making 190% more today to be in a trade than they were in 1990, outpacing the rest of society by 90%, while also outpacing inflation by about 40%. So if you're in a trade today, on average, you're doing much better than someone that's not in a trade and in a much better financial position than your counterpart who has a college education.
And the difference,
Full
when you look
stop.
at that list again, it's funny because if you look at their, it's construction labor. No offense to construction laborers, but there's more licensing with electricians and plumbers. There's a little bit more education, and it's harder to become those. Like welding isn't put in here. I would think welding might even exceed those.
And you're not paying for any of that.
Well, I mean, you're not paying, even if you're paying a nominal fee to these colleges and these
close.
trade schools.
Nowhere close.
Most of them are also, and you're doing it because listen, there's a podcaster that used to be in the other room and he stopped podcasting because he just finished trade school. He's focusing on his carpentry career. But guess how long he was in carpentry school? Not 4 years. He didn't live on campus. He didn't go to the football games and and all the other college things that, the college marketing that they've sold. And that is, again, like colleges did a nice job with marketing too. Like we got a Starbucks on campus. I mean, when I went to school, you never drank the coffee on a college campus because it stunk. And that was kind of the reason, like you didn't want to be on the campus longer than you needed to be. Now it's like the college experience has been sold as this like amazing thing. Plus colleges have like a lot of priorities now. They're into investing and in community building and all this other stuff. And I feel like that's part of why college has gotten really, really, really expensive. And then they also along the way said, you know what, 4 years isn't enough. You need 5 to 6 years because you need a master's now too, because the 4 years wasn't enough. But the trade school, like, again, you're in it for a year, maybe 18 months, depending on the program you're in.
So if you work on a prevailing wage job as a laborer and you're working for the state or whatever the case may be, Boilermakers are making $67 an hour.
Yep.
Or iron workers are making $66.29 an hour. Or actually, I'm sorry. That's wrong. They're making $94 an hour,
Yeah.
Boilermakers, because it's $67 an hour. The fringe is $26.85. Iron workers are making over $100 an hour. Like, you think doctors and lawyers make money. Like, iron workers are making $113 an hour on these jobs. Structural iron workers in New York County, which is downstate, $147. Marine drivers, $121. Carpet layers, $94.50. Like, the biggest lie told to my generation was to go to college and not go to trade school. My son does very well in school. He was on National Honor Society. He's got these idiots that are counselors telling him he needs to go to college, and I want to go into school and actually like take their head and bounce them off the chalkboard, if there is even chalkboards anymore. My son will not go to college. My son will go get a trade and go make real money without any college debt, because college is a scam.
And what I would say to my kids if they were younger, I'd say, like if you have a thing you really want to go for, and both my kids went to school and they graduated and they did it with no debts because they were smart with their college purchases and all that type of stuff. So but if like I would have tried to make trade more option if it was 10 years ago. One of my sons definitely would have been more interested in trade schools. The other one would have never been interested in trade school. But at the same time, like I think like go do that, and then if you decide down the road you want to go get a business degree because then you want to run your own business version of that, go get a license. Like, I know people that are doing this with accounting nowadays. Like, they're not going to the big fancy college anymore for accounting. What they're doing, they're getting licenses. They're doing they're going to the non-traditional organizations, are getting internships. They're basically using software. They go from bookkeeping and then they work their way up through the system from within without the 4-year degree and the $120,000 or more worth of debt. So there are people that are doing the traditional jobs that used to be college jobs that you would go get college degrees for, and they're finding ways to get into those industries kind of through a backdoor, through licensing. And I think that's what you're going to see. I think you're going to see more and more like new institutions start to offer those types of programs, and you're going to see more and more people move to that over time. Because maybe you don't want to do skilled labor, but there are things that don't require you need to go. You got to go to this fancy schmancy university, and they have like a basketball program, and you're paying more money because they have a basketball program.
Yeah.
The trade school doesn't have a football team.
Not lying. All right, we're gonna wind this podcast down. I want to share this because I was gonna we really got on a good rant, and I'm glad that we did. We spent time on a topic I didn't even expect to. I was gonna spend some time on this, but that's okay. But I do want to end the podcast sharing this. I posted this earlier this morning. For those of you that don't know, we are located. We talked about in this podcast already, so you probably know if you've been watching all the way through. We're located in Niagara Falls, New York. Niagara Falls is a very depressed area, depressed city, lots of poverty. Things are not going well here. And to give some backstory and why I posted this, there's just a lot of people in this area who, they call themselves content creators, and, maybe they are, they're making money. Cool. God bless them. But there's just a lot of complaining going on about like any sort of progress the city even talks about attempting doing. They're talking about how it's bad, how we shouldn't be doing it. And then at the same time, on the other side of their mouth, they're talking about all the bad things that go on in the city and why the city can't progress, which is true. But anytime we try to do anything, it's met with resistance. Nobody wants. They actually had. I couldn't go. I had a friend reach out to me. There was a meeting on the data centers coming in here, and everybody's mad about data centers. God forbid we jump on the technological train and try to innovate here. No good. People are mad because of water. That golf courses have more water there than data centers. And I'm not even pro data center guy. I don't even care. But what I do care about is my city and jobs, and we don't have those here, and that would bring jobs. Just going to read my post really quick. A lot of people commented on it, but I want to share this with the viewers on, my thoughts on my city. I'm going to post something that people are not going to want to hear. Too bad. Niagara Falls is a shithole right now. Niagara Falls is a decaying, decrepit, dying, if not already dead, city. However, when you people here get on social media and bash the idea of data centers, digital asset facilities, and Amazon warehouses, or any other new technological facility or idea coming to the area, in essence, you're co-signing this area, and Niagara Falls specifically, continuing to be a shithole. There are no jobs here. The traditional ones that employed most of the people of the city are next to non-existent. We either evolve to the changing technological landscape, or we shut the fuck up. Blame Restaino, who's our mayor, all you want. But this problem spans decades, both parties, and multiple administrations. We never adapt here. Environmental concerns aside, if people can't feed their families or have to live in squalor, like WTF are we doing here? For context, I personally barely use Amazon, which is true. I barely ever buy anything for Amazon. And 99% of digital assets, everything but Bitcoin, is a complete shitcoin trash. So I'm not fanboying the tech. I'm just being a realist, recognizing the changing landscape. We adapt or we die. And I think there's many, cities across the country that are in the same dilemma. They just don't happen to have a natural beauty of Niagara Falls in our backyard that we can't utilize and get people to come here and invest because we do things so ass backwards. So, this podcast is a Bitcoin cryptocurrency podcast. Obviously, I'm pro Bitcoin mining. The digital asset facilities, not so much, but if it brings jobs, cool, because people need jobs because people are poor here. The whole, AI facilities, they're coming here, whether you like it or not. So why not jump in, create some jobs, both in the trades field and people that are going to work in these facilities. In Amazon, the Amazon, I got to say this, the Amazon warehouse, for those that don't know, they built an enormous Amazon warehouse close to where I live. And Rich, do you know that as we sit here right now, there is not a bus line that drops people off in front of that huge facility that's going to be employing probably the most people in this entire area. As we sit today, because I have patients in my day job who are trying to get employment there, and the biggest obstacle is they can't get to the facility because there is no bus line that stops at the potential place that could be the biggest employer to our city. And all these assholes who call themselves politicians and elected officials, one of the reasons why I don't vote, because this is all bullshit, can't get their heads out of their asses to say, hey, we finally got something to come here. Amazon, biggest company in the world, is building something here, and people are going to get employed by this place. Do you think putting a bus stop out front to have the people that are going to be in the poorest parts of the city potentially coming to make $20 an hour plus jobs to work at can get to that facility might be a good idea?
I was not aware of that, and that's just horrifying. That there's not a bus route there, and especially when you consider that, it's not out of the way in the sense that you could change one bus line that would go down and around to come back to Niagara Falls Boulevard. They could loop around that would just go up to Walmore Road where the air base is that's there as well, and loop back around and hit Niagara Falls Boulevard, and you could transfer the bus and get back on a different bus. Like, there's no reason you can't have a bus line, a couple buses a day that it would not be going that far out of the way. That's just crazy.
Business as usual
That's
for this
just
area.
really that's really frustrating.
Yep. As always, don't trust, verify. Peace.